Okay. So the finance bill of 2024 that was withdrawn had a number of important changes for the pension sector. In particular, there was a significant change that was made in the tax deductible limit on pension contributions. For the last 20 years, the ceiling on tax deductible contributions had been 20,000 shillings. In the finance bill, this was being raised by 50% to 30,000 shillings. So this would have significantly incentivized pension savings in our country. As I mentioned, this limit has not been reviewed for the last 20 years, and it was long overdue. We hope that in whatever form the bill is brought back, that at least that provision is retained. The other thing that the finance bill also did was to improve the taxation of benefits on exit when people are retiring or otherwise exiting from employment. And again, those were good changes for the sector. We hope that they will be reinstated. When it comes to the Gen Zs, they do not want a rigid, when it comes to pensions, they are not looking at a rigid pension scheme which says you join, you stay for life, you contribute for the next 30 years, and yes, we'll give you something in your retirement. They are talking about instant gratification. What can they get now? And therefore, one of the things that we are looking at as Zamara is how do we make our pension systems more relevant to the needs of the newer generation. If, for example, they are looking at the immediate future, not the retirement future in 20, 30 years' time, how do we still help them to save as we start preparing them to think about saving for their future? So can we help them save for their short-term priorities? Could we help them to save for housing? Could we help them to save for their other needs, their education and the like? And I believe that the pensions infrastructure that we have in Kenya is solid. If we can accommodate wider savings priorities through our pension system, this would be a good step. It would make our pension system more appealing to the younger generation, to people who are looking for something different. Secondly, the young generation is very tech savvy. They don't want to just get a benefit statement once a year. They want to be able to see, be able to visualize. They want to be able to see their benefits. And some of the things that Zamara are working on is how we can help people see the power of 1% interest or accumulating small amounts of money, how they can make a meaningful impact in their future. So what happens in Kenya is that a lot of these pension schemes, retirement schemes, are still provident funds. So what they do is when people retire, the benefit is paid as a lump sum. Okay, so the entire amount is paid as a lump sum. And people who are not used to having that sort of money in their hands just at one go, people who are used to having a regular income in their lives, getting so much money at one go, the tendency is to squander it or not properly apply it. So our research shows that people who retire, unless they are guided on the type of benefit they should take, there is a big risk of the money not lasting them long. And our research shows that it is depleted within 3 years. Okay. Now, what are some of the things that Zamara are doing? So first and foremost, we are motivating to the government that, look, we need to reduce the extent of provident funds in our country. More of the benefit should be paid in the form of a regular income in retirement. For people who are retiring or exiting from Zamara's database, we encourage as much as possible for people to look at the options, such as taking an annuity from an insurance company or looking at an income drawdown, which is a phased withdrawal of their benefit from a scheme, so that they are not taking everything at one go. There is a little bit of guidance, financial advice that is being given so that people make informed decisions. Because remember, once that money is gone, there's not much that can be done. And people then start falling back and become a burden on society. Look, we have made a lot of progress in Kenya as a pension sector. And to say that our sector is now just shy of 2 trillion shillings in assets is a commendable achievement. However, when we look at the level of coverage, it is still very small. When we look at the level of benefits that people are taking from their schemes, it is still very small. Okay? Yes, pension assets have increased, but relative to the size of the economy, the assets as a percentage of GDP have remained at about 12 or 13%. If we are to grow at a much faster rate as a country, we need to have a much bigger savings pool. One of the best ways of mobilizing those savings is through pension savings. So we are hoping that the government and all stakeholders can engage on how we can increase the savings rate in pensions and how we can use the pension sector to better mobilize those savings. So yes, tax incentives is one thing. How do we make a minimum level of pension contribution compulsory? How do we get the informal sector to participate in pension arrangements? Those are some of the conversations and policies that we need to think about.
In terms of the policy that has come forward, I must say that as an institution, we are in the forefront. We just rolled out the retirement benefits policy, a policy that we have actually worked on for a long time. This policy has actually been contributed a lot by the various industry players. And one of the things that comes out is that the future of this country and the future of pension would actually rely a lot in terms of the implementation of the policy. One thing that comes out, and Sandeep has talked about, is the level of coverage. Currently, we are talking about 26% of the total workforce in this country contributing to pension arrangements. We still have an opportunity out there, mainly in the informal sector. And what we need to do is to make sure that we continue to educate and really be able to reach out to those in the informal sector, ensure that the incentives that come in for people to save more towards retirement are actually implemented. One of the things that came out in the finance bill that was stood down was actually the aspect of increasing contribution, as it has been said. It's an area that we've worked on for a long time, and we are happy that at least government has seen it fit that there is need to encourage more contribution going to the pension scheme. But even those who are retiring, the issue of tax, something that really is, has always come to our desk, and we are happy that at least the pronouncement that has come from the CS National Treasury is that there is need to reintroduce that, and we are really working very closely with National Treasury to make sure that that particular arrangement is brought back, so that even those who are retiring, they can really be able to enjoy better benefits as a result of what they've saved in.
We all know that our pensions asset base, and I'm sure Mr. Kiptanui from the RBA will be telling us later, is just short of 2 trillion shillings. This is a significant achievement. Pensions coverage in our country is increasing slowly. Pension schemes are being run so much better than they used to be being run many, many years ago. The trustees are more aware of their duties and responsibilities. Service providers are well switched on and are delivering well to pension funds. But despite these achievements, we are still confronted with many stark realities, which we need to face. And these are things that we have talked about repeatedly year after year. Yes, pensions coverage has increased to about 20%. But is that enough? 80% of our population is still excluded from the mainstream pensions. Even those who are saving through pension schemes, these are people in formal sector employment. Their pension replaces, on average, based on the Zamara research, only about 34% of their last income, when the global target is about 75%.
Adam, please treat it as boss Adam. We have no any push that you will have a successful meeting, although
on the screen before, there was a notice in terms of data protection. You'll notice
our main restaurant, Pavilion Restaurant. So I wish you well, and I wish you a successful meeting.
Innovation, innovative and resilient pension systems. Retirement medical as one of the innovative solutions that we have. We'll talk about on those topics. And then finally on day 3, we'll be looking at building resilient and sustainable. Give us some welcoming remarks.
You saying Mr.
Sorry. Yes, take the on stage. Zamara's Group Chief Executive Officer.
Face. So the first one is around knowing your clients or identifying.
Our convention in terms of the presentations that are going to be made. So you can see on our program. Also at the beginning, he talked about the journey of 30 years. I think he mentioned he joined Zamara.